Scan any major cryptocurrency forum and you will see the same conclusion. The 4-year cycle is dead. The theory is that because Bitcoin hit new highs before the halving and ETFs have entered the market, the old rules no longer apply. This panic is a reaction to emotional noise. It prioritizes short-term price volatility over the structural data that actually governs the market. The cycle has moved into a new phase of maturity. Bitcoin is transitioning from a retail-driven speculative asset into a professional institutional product, which has altered the speed and rhythm of its movements. We are going to map out the specific data points driving the market toward 2026 to see how the cycle is actually functioning behind the headlines. Mistaking a change in the market's velocity for a change in its direction is the fastest way to misjudge the eventual peak. Skeptics point to Bitcoin's rally ahead of the recent halving as proof that the historical timeline model has been destroyed. This chart tracks current price action and whale wallet holdings against the same periods in 2016 and 2020. Even with the early price move, the mathematical consistency of the 66 accumulation phase is still visible. The on-chain behavior of massive whale accounts right now follows the exact accumulation structures we saw during the previous 2 cycles. While the behavior remains the same, the entry of institutional capital has compressed the timeframe. Phases of retail boredom that used to drag on for 18 months are now being completed in 6 months of institutional positioning. The timeline is accelerating. Investors relying on an outdated 18-month clock are effectively allowing institutions to front-run their strategy. There is also a common belief that the halving is a manual trigger for price growth, and that any delay in vertical movement means the model is broken. The halving is a mathematical supply shock. This reduction in new supply only impacts price when it is met by a corresponding wave of market liquidity to absorb the remaining coins. The engine of the 48 Bitcoin market cycle is managed here, at the Federal Reserve and through the broader macro business cycle. When we plot global M2 money supply expansion against Bitcoin cycle peaks, the correlation is exact. Bitcoin rallies when the macro environment is flooded with liquidity. The current environment has created a structural split. Capital is flowing into institutional-grade assets like Bitcoin, while speculative interest in smaller altcoins is beginning to diminish. While retail traders watch the halving, professionals monitor the liquidity clock. Macroeconomic shifts have always been the primary driver of these cycles. Despite the shift to institutional control, the 77 trading psychology of the market remains consistent. Human greed in a high-liquidity environment still follows a predictable path. However, the top of this cycle will not look like 2021. That peak was fueled by direct-to-consumer stimulus checks, a factor that is no longer present in the market. To identify the peak of the 2026 cycle, we have to look for the point where retail exhaustion meets institutional saturation. This happens when the market shifts from retail FOMO into institutional yield chasing, the moment when Bitcoin is no longer viewed as a speculative bet, but as a mandatory corporate holding. Historically, a cycle reaches its limit when risk is repackaged as safety for the most conservative buyers. Watch for major legacy banks to stop warning their clients about Bitcoin and instead begin marketing it as a safe yield asset. That shift from skepticism to universal promotion marks the point of full market saturation. Using the retail rules of the past makes you the exit liquidity for the present. Survival requires moving away from the noise and following the macro data.